For a few years, it felt like anyone in America could buy a house, no matter their income or job. Behind the scenes, Wall Street was turning risky mortgages into investments rated as safe as cash. When the cracks finally appeared, billions vanished overnight. How did a housing boom set the stage for the most destructive stock market crash since 1929? Banks and mortgage lenders began pooling thousands of home loans, many made to borrowers with shaky credit, into giant bundles called mortgage-backed securities. These bundles were then carved up into slices or tranches, each with a different level of risk and reward. The safest tranches, sitting at the top, were designed to take losses only after all the lower layers were wiped out. Rating agencies stamped many of these top slices with AAA ratings, the same grade given to government bonds, even when the underlying mortgages were anything but safe. But the process didn't stop there. The riskier, lower-rated tranches left over from one bundle were gathered up and repackaged again into new products called collateralized debt obligations, CDOS. This added another layer of complexity, making it even harder to see where the real risks lay. Investment banks earned hefty fees at every step, originating loans, creating securities, and selling them on to investors around the world. As demand for these so-called safe assets surged, the system fed on itself. Lenders loosened standards to create more loans, knowing they could quickly pass the risk along. By 2006, more than half of all subprime mortgages were being bundled and sold as securities, with many of the riskiest slices somehow still labeled AAA. On paper, the risk seemed to vanish. In reality, it had simply been spread across the global financial system, hidden by layers of financial engineering. In the summer of 2006, the Case-Shiller Home Price Index reached its highest point, capping off years of relentless growth. In cities like Phoenix, home values had doubled since the start of the decade. For many, it was easy to believe the boom would never end. But beneath the surface, trouble was brewing. Adjustable rate mortgages, ARMs, began to reset. Monthly payments that started low suddenly jumped by hundreds of dollars. For borrowers who had stretched to buy at the peak, the math no longer worked. Maria, a nurse living in the outskirts of Phoenix, had bought her home with a 2-year teaser rate loan. She and her husband made their payments on time, trusting they could refinance before the rate changed. When the letter came, their mortgage payment rose by nearly $900 overnight. Home prices had started to fall, making refinancing impossible. Maria remembers checking the mailbox every day, dreading the next notice. By early 2007, their savings were gone. The foreclosure notice arrived in March. Maria packed up her children's toys, unsure where they would go next. Stories like Maria's played out across Phoenix and the rest of the country. In 2007, foreclosure filings in Maricopa County soared to 36,000, a 136% jump from the year before. Nationally, more than 2 million families lost their homes. The numbers made headlines, but behind each statistic was a family in crisis. As payments stopped and homes emptied, the effects rippled outward, first through neighborhoods, then into the balance sheets of major lenders. In April 2007, New Century Financial, once one of the biggest subprime lenders in the country, filed for bankruptcy. The company had handed out billions in risky mortgages, but when homeowners began to default in droves, its business collapsed almost overnight. Employees packed up their desks as federal investigators arrived, searching for records. The company's fall sent a chill through Wall Street, raising questions about the true value of mortgage-backed securities held by banks everywhere. Just weeks later, another alarm sounded. Bear Stearns, one of the most respected names on Wall Street, scrambled to rescue two of its hedge funds that had loaded up on complex mortgage investments. In June and July, Bear Stearns poured $3.2 billion into these funds, hoping to stop a fire sale that could send prices of mortgage securities into freefall. The effort failed, losses mounted, and the funds were liquidated. For the first time, the pain of bad loans had jumped from homeowners to the heart of the financial system. Bankers who once believed these products were safe now faced the reality that nobody really knew what these assets were worth. Fear began to spread as the flow of money between banks slowed and trust started to unravel. On a Thursday morning in March 2008, Bear Stearns traders watched as billions vanished from the firm's accounts in a matter of hours. Counterparties refused to roll over short-term loans, and the bank's cash reserves evaporated at a stunning pace. By Friday, Bear Stearns was locked out of the market. Executives scrambled to reach the Federal Reserve, desperate for help as the firm's survival hung by a thread. Inside the Federal Reserve, officials weighed the risk of letting a major investment bank collapse. The fear was clear. Bear Stearns' failure could ignite panic across Wall Street. In a late-night negotiation, J.P. Morgan Chase agreed to buy Bear Stearns for just $2 a share, a fraction of its $170 peak, with the Federal Reserve providing a $30 billion backstop through a special entity called Maiden Lane. The deal was hammered out in the early hours of Sunday morning. For Wall Street, the message was unmistakable. Even a storied firm could fall in days if trust evaporated. The entire system now depended on fragile, short-term funding that could disappear overnight. By late summer 2008, the gears of global finance started to grind to a halt. Banks that once lent freely to each other now hoarded cash, afraid that the next collapse could be their own. The cost of short-term borrowing between banks, measured by the LIBOR-OIS spread, shot up to 3.5% in August, an unmistakable sign that trust had vanished. On Wall Street trading desks, funding managers watched as overnight loans dried up, leaving even the biggest names scrambling for liquidity. Fannie Mae and Freddie Mac, responsible for backing over half of America's home loans, stood on the edge. On September 6th, federal regulators stepped in, placing both giants into government conservatorship to prevent a wider collapse. But the system was already under immense stress. Just 9 days later, Lehman Brothers, with $639 billion in assets, filed for bankruptcy on September 15th. Inside Lehman Brothers headquarters, executives faced a tidal wave of margin calls and vanishing credit lines. The failure sent shockwaves through every corner of the financial world, freezing lending and pushing the crisis from Wall Street into the global economy. Hours after Lehman Brothers collapsed, American International Group, AIG, stood on the edge of failure. On September 16, 2008, the Federal Reserve authorized an $85 billion emergency loan to keep the world's largest insurer afloat. The downfall of AIG threatened more than its own balance sheet. The company had written hundreds of billions in credit default swaps, promising to cover losses if mortgage-backed securities soured. When those securities collapsed, AIG did not have the cash to pay out. The risk was not limited to Wall Street. AIG contracts backed banks and pension funds across the globe. If AIG had defaulted, the shock would have rippled through every major financial center. Regulators moved fast, taking a 79.9% stake in the company. The government's total commitment to AIG would eventually climb to $182 billion, making it the largest bailout of the crisis. Overnight, trust in the global financial system vanished, and credit markets froze, forcing governments to act on a scale never seen before. On October 3, 2008, Congress passed the Emergency Economic Stabilization Act, unleashing $700 billion through the Troubled Asset Relief Program, TARP. The aim was immediate: buy up toxic assets and inject capital into the nation's largest banks before the system collapsed entirely. In a closed-door meeting, Treasury Secretary Henry Paulson compelled 9 major bank CEOs to accept a combined $125 billion, whether they wanted it or not. Economists warned that the true cost would reach far beyond Wall Street. By the end of the crisis, American households had lost $16 trillion in wealth, wiping out retirement savings and home equity. In response, lawmakers introduced sweeping reforms. The Dodd-Frank Act, passed in 2010, promised to rein in risky practices and prevent another meltdown. Yet the debate over bailouts and moral hazard lingers. Did the rescue save the economy, or did it simply reward recklessness? The answers remain unsettled. Today, the global financial system remains deeply interconnected and still vulnerable to complex risks. Markets have rebounded, but over $16 trillion in household wealth was never recovered. As new bubbles form and regulations shift, the question is not if shocks will come, but whether we will recognize the warning signs in time.